Let's go straight to the Monetary Policy Committee of the Central Bank, which held all rates parameters unchanged in line with analysts and markets' consensus. But the big takeaway was the Riot Act that the financial regulator read out to the FX Bureau regarding the sale of foreign currencies and what the new FX regime will look like. Take a listen to the Central Bank Governor, Boason Omofaye, a short while ago.
We have continued to observe that stakeholders in some of the subsectors have not been helpful in this direction. In particular, we have noted with disappointment and grave concern that our bureau de change operators have abandoned the original objective of their establishment, which was to serve retail end users who need $5,000 or less. Instead, they have become wholesale dealers and illegally in foreign exchange to the tune of millions of dollars per transaction. The bank has an understanding with bureau de change operators that they make a small margin from sale of the US dollar allocated to them per week. They have reneged and become somewhat greedy, recalcitrant, with abnormally high profits from these sales, while ordinary Nigerians have been left to feel the pain. The bank has noted the following unintended and unfortunate outcomes. 1. Avalanche of rent-seeking operators operators only interested in widening margins and profits from the foreign exchange market, regardless of prevailing rates in the market. 2. Gradual dollarization of the Nigerian economy with attendant adverse consequences on the conduct of monetary policy and subtle subversion of the cashless policy initiative of the Central Bank of Nigeria. 3. Prevailing ownership of several bureau de change by the same promoters in order to illegally procure foreign exchange multiple times from the Central Bank. 4. Numerous and repeated financing of unauthorized transactions with foreign exchange procured from the Central Bank of Nigeria. 5. Indeed, we have evidence that several international organizations, embassies, regrettably, and development finance institutions, I repeat, regrettably, operating in the country, patronize BDCs through illegal Forex dealers to fund their local operations in further and flagrant contravention of our foreign exchange laws and regulations in Nigeria. We will deal ruthlessly with the Nigerian banks who have acted as collaborators with these illegal Forex dealers. We will deal with them ruthlessly because they have allowed their banking and payment system infrastructure to be used to facilitate this illegal dealing in foreign exchange. As for those foreign organizations involved, we will report them to their regulators. We will write to those organizations seeking their understanding and that they must desist. If they seek to operate in Nigeria, they must go through the right channels through which they must procure either foreign exchange or procure naira for their domestic operations. These unintended outcomes have placed an unsustainable and enormous financial burden on the CBN. We are also concerned that bureau de change have become a conduit for illicit financial flows. Indeed, the facts abound that BDCs have turned themselves into agents that facilitate graft and corrupt activities of people who seek to conduct illicit funds flow and money laundering in Nigeria, and we will go after all of them. After these exhaustive and comprehensive deliberations, the management of the Central Bank will, with the full support of the committee, reach the following decisions which will take immediate effect. A. First, the Central Bank will henceforth discontinue the sale of foreign exchange to bureau de change operators. B. bank will no longer process or issue new licenses for BDC operations in the country. This stoppage extends to all licenses being currently processed, regardless of the stage of that processing. C. The bank would henceforth channel a significant portion of weekly allocations currently meant for BDCs to commercial banks to meet legitimate FX demand for ordinary Nigerians and businesses, whether for small-scale imports, medical bills, educational expenditure, personal and business travels, or any other legitimate needs as prescribed by the CBN's foreign exchange manual. D. All commercial banks in the country will, with immediate effect, create a dedicated teller point in designated branches for sale and disbursement of foreign exchange to customers who desire FX for legitimate purposes.
But while the latest crackdown on FX misbehavior is such a big story, the decision of the MPC to hold policy rate at 11.5% is not to be taken lightly. Let me introduce my guest on this and more. Here at our Lagos studios is Steve Osho, co-managing partner and head financial advisory at Commercio Partners. And from our Abuja studios, welcome Professor Kenneth Ife, a development economist. Gentlemen, thanks for coming through. We have a three-part conversation before us, so let's get started on the main policy meeting itself. We'll get to the FX in a short while. Is the monetary policy decision to hold all rate parameters in line with your thoughts at Commercial Partners? Let me start with you, Steve.
Thank you, Boason, and it's a pleasure to have me again today. From our standpoint at Commercial Partners, all the parameters based on what came out of the MPC meeting today was what we're expecting. We're expecting them to keep all the MPR stable at 11.5, liquidity ratio at 30%, CRR at 27.5, and the asymmetric corridor constant at plus 100 and minus 700 basis points around the MPR rate. So I think the expectation was in line, and the outcome of the results to the outcome of the meeting today was actually in consonance with what we're expecting at the meeting.
Okay, so we have about a minute to go on break, but before that, let me ask you, Professor Kenneth Ife, is this whole decision what you thought all along is appropriate at this point in time?
Yes, I expected all to stay as the same, and if you take the MPR rate, I wouldn't see the need to actually tinker with the rate, because we're already an economy in stagflation and just came out of it, and there's so many hostages to this particular decision. So I was happier that CBN was using open market operation and of course active in the treasury bill market and all of that. So use that to mop liquidity rather than tinker with the rate. So I was comfortable with that. Then on the cash reserve ratio, I was also comfortable with that, because there's no need playing with that, since already the government, the CBN has actually asked the banks to come and take the 4 trillion in their holding at zero interest for them and then go and lend. So there's no need moving that up and down. Then on the liquidity ratio, there's no need again. So I was happy for
Professor
that.
Ken, Professor Ken Ife and Steve Osho, let's stand by. We expand this conversation after the break. Stand by, everyone. Thank you very much. Back to the post-MPC decisions analysis here on Arise Exchange, discussing the key highlights and what they mean for the markets and the economy. Is Steve Osho of Commercio Partners and Professor Kenneth Ike, Development Economist from our Abuja studios. Thank you, gentlemen. Prof, you were talking about why you were satisfied with keeping the CRR and the liquidity ratio. So I'm just going to take that straight to ask Steve. What do you think the whole decision would mean for the economy now until September, when the next monetary policy meeting will take place?
Just a reflection of what the CBN has actually been trying to achieve in terms of the monetary policies and the harmonization with the fiscal authority. At this point in time, the old policy on all the asymmetric corridors, the MPR, the liquidity ratio, the CRR, just mean that we need to watch the effect or the transitory effect of what all the policy that we've been putting in place since the beginning of this year, or since the, we've actually started the experience of the COVID-19 and the effect of that on the economy and on the economic activities generally. So this is very important now for them to actually wait and see all the policies that have been doing around the anchor borrowing, around the trying to maintain the liquidity in the system and keep the exchange rate stable, vis-a-vis trying to make sure that there's a check or rein on inflation. I think this is very important at this point for them to actually see the effect of that. And at the same time, we've seen how the inflation rate has started moderating lower from the high point of 18.9 levels to around 17.75 based on the last figure that was released. So I think it's very important for them to actually, pause at this moment, to actually reflect on all the monetary policies they've actually been rolling out since the beginning of last year till this year, and see how that would, translate into improved economy going forward.
Yeah, so if we reflect on this, let me ask Professor Kenneth, if very quickly, for about a minute, let's reflect over the last 18 months, in particular since the end of Q1 last year, when we started these very furious interventions on stimulus on the fiscal side, on the monetary policy side. Do you think we've done enough interventions yet? Are we seeing the effects of those interventions on the positive side? Are there downsides to it? That's what Steve will speak to me about. Prof, you go first.
Well, I think we've done well, to be honest with you, compared to other countries. The combination of quantitative fiscal and monetary intervention have actually ensured that there was a balanced approach, both on the output side and on the consumption side, to ensure that what is produced is actually the capacity to buy them was there. Over 300 billion went from CBN to reach the household and then reach the MSMEs, and in other words, to close those gaps. So that's one of the main reasons why we jumped out of stagflation within a quarter. And then, thank goodness, the inflation is moderating, and also the growth figures are also keeping up, but we could be better. So in those circumstances, financial system stability is also good, because you've seen the loan-to-deposit ratio lower. It is lowering down to prudential guideline of 5%. It's just about 6-point-something%. You've also seen the other adequacy ratio, capital, is over 15% on average. So they are doing well. So the whole system is stable, and which is what it was designed to be. So the whole normalization of monetary policy should be towards the end of the year. And I can see many banks around the world are looking at the end of the year to begin the normalization. Bear in mind that one of the measures that was embarked upon was to allow the central banks to give them the statutory forbearance to be able to restructure loans and reduce the interest rates and all of those. So those easing are somewhere going to come in much later in the year or early next year. But on the other hand, in order to contain the issue of the money supply issue, then the CBN is beginning to mop up liquidity in an indirect way, using open market operation and T-bills and all of that. So in a way, without tinkering with these indicators, those monetary policy indicators, we are still achieving both that balance.
Prof, so but down the last 18 months, here we are with our exchange rate not in a better position than it were last year, as well as inflation as well. So, Steve, let me ask you, what's your view at Commercio Partners in terms of all this put together over the last 18 months? It's taking us to where we are at the moment, still holding rate. Prof believes that we should do normalization by the end of the year.
Well, Boason, you see, everything we're actually going through now as a nation is as a result of all the effects of some of the things that we refuse to plan from the fiscal side, and partly because of the issue we had or we experienced due to the lockdown period we witnessed during the pandemic, from last year. And at the same time, a lot of other fiscal policies that actually, came through by shutting down the borders and stuff like that. So we've seen the filter effect of that, of some of these policies, from the inflation number, from the GDP number, and again from the growth and stabilization process we're trying to achieve. And I think going forward, coming out from recession, and even with the projections of the GDP growth for 2021 to remain around 2 to 2.5% by IMF, and from CBN governor earlier, we heard they're projecting around 3%. I think it's still going to be a long way out between now and the end of the year. I think a lot of things actually needs to start opening up in terms of opening up the economy. We are coming out of that stagflation gradually, but again, I think we still have a long rope to climb through before the end of the year. We're talking about how we need to free the economy in terms of employment, how we need to, improve the output, of the economy. And we can only do that by fixing all the other parameters we talked about here. So all the parameters that are actually being used from the monetary policy tools are something that at this point in time, based on the accommodative monetary stance of the government, of the CBN governor, it's difficult for them to actually tinker with that at this point in time. And considering the fact that we're at a delicate point, at the same time, coming from the pandemic and the effect of that on the economy, and the price of oil has dwindled down a bit, even though we're picking up now, it's a bit difficult for them actually to change that dynamic by saying we're going to tightening motion period of the economy. So it's a win-win situation at this point. But I think in the long run, before the end of this year, everything will depend on how we can create job, employment, open up the economy, and allow business actually to continue to grow. That will actually translate into naira and kobo and the increase in output of the economy.
Well, let's get to the elephant in the room, which is the FX. Of course, it looks like this is a very critical denominator of whatever conversation we're having, aside insecurity and a few things like that. So here is the central bank governor today, visibly worried, visibly angry and upset about what he called those infractions and misbehaviors within the FX market by a whole lot of folks on the street, from BDCs to banks and a few others. So I want your first word on this when we come back. But very quickly, let me allow you to raise the curtain on this. Mr. Professor Kenneth Ife, do you agree with Mr. Governor when he spoke very strongly against those infractions and those who are bypassing the official sources in terms of FX transactions?
Well, the central bank is the regulator of that market, and you have to give it to them. And the concerns that they raised are in public interest. And a lot of them are border on security, they border on impropriety, they border on money laundering and the terrorism financing, all kinds of things that are really within their purview. And I have to say this. It is within their right to do what they're doing or say what they're saying. It's also, I'm not aware of any bilateral, plurilateral or multilateral trade agreement anywhere that says that any central bank should fund importation or exportation or even giving money to. I don't see any of them. But correct me if I'm wrong. But I am not aware of that. So, but I do know that there was good intention from the bank in bringing in and allowing and supporting and nurturing the BDC as a third tier. And it's very, very necessary for them to be there. And okay. I'm glad they didn't cancel them out.
Okay, we'll be back on this very important conversation. Professor Kenneth Ife, we'll take a very quick break. What is the central bank looking to achieve in a short to medium term? Let's discuss that when we return. Well, you're welcome back to the program. Just as we're having the conversation about the whole FX markets in Nigeria and the central bank latest riot act, the International Monetary Fund has just released its latest World Economic Outlook update. This is coming through. The International Monetary Fund has warned that there's a risk inflation will prove to be more than just transitory in developed economies and could be a persistent feature, and is now saying that the central banks around the world will have to move in. In other words, the IMF says central banks around the world will have to start to curb their accommodative monetary policies, such as tapering of market-friendly stimulus like asset purchases. The IMF has also revised the global economic outlook for this year from 4.4% now to 4.9%. The IMF says in part that more persistent supply disruptions and sharply rising house prices are some of the factors that could lead to persistently high inflation. That's just coming through from the IMF. We're bringing everybody to speed. That's just breaking news released from the IMF in Washington. But let's continue with my guest here in Lagos, Steve Osho of Commercio Partners in Lagos and Professor Kenneth from Abuja Studios. Let's continue with this. The IMF has just spoken that the central banks around the world will now have to start rethinking their ultra-accommodative policy stance, which started last year. So we're talking about the spending by the central banks since last year. The IMF says inflation is here to stay. It's not transitory, as we heard a few days ago from the U.S. Central Bank Chairman Jerome Powell. But let's talk about this FX. So where do you think the central bank is going, what it's looking to achieve in the short to medium term? Because you cannot divorce inflation and exchange rate from Nigeria's inflationary environment. Talk to me, Steve. Let me go first.
Well, I think from this point of view, to us today, the FX policy or the Riot Act was read by CBN governor today at the MPC was a bombshell, if I want to start with that first. And I think from the policy thrust that's been rolled out, even though we don't have the detail yet, maybe a lot of other circular will come in line or after this particular communique has been released. But I think what they're trying to achieve is just to say that there are a lot of inefficiencies in the system. There are a lot of slippages of currency that has been given to the BDC going to some irregular hands or mismanagement of the Forex or the hard-earned, Forex, which at this point, looking at where we stand as a country, looking at the amount of reserve that we have, coming from the highs of upper 40 to around 33 billion right now, I think the CBN is a bit worried and concerned that the money that actually pushing out to that sector is actually going down the drain and is actually not, addressing the main issue or the real reason why the BDC is actually set up first, which is the reason to bridge the gap between the parallel market and the official market, especially to the critical sector of retail segment. So I think that's what they're trying to achieve. But for me, the concern I have about this is actually the timing this is actually coming through, because there's one thing for the policymaker to look at problem and issues that they have, and another thing is just for us to look at how this will affect us going forward. And if you look back or piggyback into history, in 2016 we actually had under the same MFLA, we had the same issue in 2016 when there was a global headwind in terms of economy, and the oil price actually came crashing, and the same policy actually came out during that time, which made them to stop the sale of FX to BDC and now transfer all the sale back to the bank. And within a month, we saw that the parallel market moved from 277 naira to $1 to about 370 naira to $1 within a month. And within the same year, before the end of that year, the FX was already, the Naira to FX exchange in the parallel market was already touching, in terms of transfer, was touching as high as 500 and 517 before the ironing window was now introduced in April 2017. So I think we are going down the memory lane again. And I don't think we achieved anything between that time, because what we achieved was we actually saw the price, skyrocketed, and at the end of the day, we actually came up with some other policy, which are, for me, is what we should be looking at as a country and as an economy now. What are those things we need to look at? Considering the fact that the most of the earnings that we actually receive through the reserve is coming from oil price, and considering the fact that even the world economy is moving away from fossil fuel, which is the main source of our own FX proceeds, I think we need to look at some other practical steps for us to look at this. I'm not saying the policy in terms of actually cutting down the sales of FX to BDC is actually wrong. Like the professor said, is within the means of CBN to do that. But I think we need to look at the timing, and we look at history. What have we gained, even when we actually applied this same policy in 2016? For me, it was a weakness of the currency to 517. the main solution came through the ironing window, which actually now attracted a lot of offshore investors, portfolio investors, FDI into the system. Right now, I don't know if that's the direction we're going or not. But again, I think time will tell, and we'll see how this pans out in the long run.
How do you think, or what do you think the central bank is trying to achieve, Professor Kenneth Ife?
Well, I think the central bank wants to sanitize the Forex environment, and is approaching it in a way that is consistent with their oversight, with their regulatory purview. Now, but what I'm not sure is whether time will prove whether commercial bank is the better of the two evil. Only time will tell. The thing is this, we've been through this road before, as the previous speaker just said, and we will all agree that there is a necessity to have CBDs, that's without a doubt, because that third tier is very critical for the base of our economic pyramid. And we know that 90 million MSMEs in Africa, 41 million in Nigeria, almost 50%, yet we are only 18% in terms of GDP and size of economy and population. So it showed that entrepreneurship is really a very strong area for us. And the commercial banks failed to deliver inclusivity in the handling of these Forex regimes before, which was what gave rise to these BDCs coming in. So they have an important role to play. It's just like saying to me that you don't want local government anymore, although that's protected by constitution. But in this case, the BDC don't have that kind of protection. But having said that, the CBN is doing what it can do. But we will have
Professor Ken, the Bureau de Change will still exist.
That's why I'm happy that they will
source their FX, not from the central bank. They've got to look for autonomous sources.
That's right. At the same time, the commercial bank should also source for their own Forex. You could see that people like Fidelity Bank is working with Nigerian Export Promotion Council and Lagos Business School to support MSMEs to export. We should have all the banks doing the same, working hard, having a business advisor in every branch of their all over the country, so that they can actually talk to the industries, move out and see the entrepreneurs, rather than sit back in the office and do armchair banking. They should get out and then get it. Even London, when I order things from abroad, I've never seen any of my banks go to Bank of England to ask them for Forex. So we should do the same. None of them should have monopoly of this Forex. But CBN is doing what it should do, and I have no difficulty with that, and I support what they're doing. But we should understand that only time will tell whether commercial banks are the better of the two evil when it comes to all the infractions.
All the FX.
They're all the same.
Yeah, but we've got a really long road, and I agree with you, Prof, that we've got a long road. Steve, how do you think the markets will react to all of this? I'm sure on one side we have the rich decisions moving forward until September next meeting. Then you have the FX, which you call a bombshell.
Sorry, I didn't get that, Boason.
Yeah, I'm asking how the markets will take this development this evening. First, we have the do nothing, hold rates, hold your firepower. Then you had the whole bombshell around the FX.
Well, I don't know. I think it's going to be very tough going forward how the market will react. But like if the history is actually a better judge for me, I would say that we're going to see a lot of pressure on the currency going forward. Right now, I think the parallel market we're seeing around 5.15 to 5.20 to $1. What will happen going forward is that we might not really see that supply coming through again, and you have to go through the bank to get the PTA, BTA, and school fees. There's always a limit on that and a cap on that. But through the BDC, even though they render return to CBN, a lot of them actually could sell as much as possible. And if you look at how much you actually can raise, if you are actually paying for school fees, it's about $15,000 per term. For those who have like 3 or 4 kids outside the country who are paying school fees in actually foreign currency, how do you think they'll be able to get that? So there's going to be a lot of moving parts as far as I'm concerned regarding this particular policy. But in the meantime, I think the paucity of supply to the BDC and transfer of that supply to banks would cause a bit of delay in terms of process, because the banks will always come up with the documentation which you have to fill before you actually can get to those Forex. And I expect to see a lot of long queue in the bank going forward. Whether they have the ability or the capacity to be able to handle that now is what I don't know. I was talking to a friend of mine before I came here, and he told me he went to a bank to actually buy PTA last week. He spent 2.5 hours in the bank despite giving them all the documentation that they needed for that particular payment, and which is just $4,000. So imagine if you now have a whole lot of people, and we're not going into summer where a lot of families will be going on trips and traveling. So I don't know, it's going to be a bit messy at first, but in the long run, I think we're going to see how it's going to pan out. But if history will judge me well, going by what happened in 2016 to the early 2017, Steve, I think it's just going to happen the same.
Do you think the central bank will be able to move the wholesale volume of the FX now from the BDCs to the banks? Do you think this will happen?
Well, that's what they're doing already. You know, they are moving everything to the bank. So, which means that if you need to actually buy any of those invisible transactions or any of those transactions you have to have within the retail sector, you have to go to the banks. So everything has been moved to the bank, as it were. And what we have now is joblessness on the part of people that have BDC, and we're talking about 5,005 BDC and more. So I don't know. It's you know, everything has a filtering effect that we're going to see going forward, but how it will pan out, I can't really talk about it right now. Well, we can only wait, the time will tell.
Well, let's wait and see. The World Bank, the IMF, has asked Nigeria to float the exchange rate and close the gap. Professor Ken, do you think the Emefiele and the rest of his team are moving in that direction right now with the current development?
Well, I'm not sure I agree with floating the rate, because there's no such thing as floating the rate. You have to have a degree of managed float, because we are not in an ideal world. We have more demand for our Forex than what Forex we can earn. And whatever we can earn, 90% of it is monocultural, depending on oil and gas. We have no control over the production. We have no control over the market price. And then even when they arrives, now that we have differential, we can't even see the differential. You don't see it in excess crude account. You don't see accretion of it into the foreign reserves. So, we've got to diversify this economy. And we are not in a position to at all. South Africa has heavily diversified the economy. You have metals, you have so many things giving them money, but not us. We need to diversify this economic base. And there are many things that will actually give us more confidence if we reduce the hemorrhage on our Forex by importing refined products and all of that, transporting it and ferrying it. If we remove that, and hopefully if Dangote so on comes in on stream, and then if rail begins to reduce the cost of transportation, which is astronomical, then we can have and then more export going out to raise more revenue, more forest revenue. Okay, then we will be at that liberty to start considering that option.
I thank you very much, both of you, gentlemen. Steve Osho, co-managing partner and head financial advisor at Commercio Partners, and Professor Kenneth, Development Economist. Thank you both for your time and insights on the show tonight.